This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
We've all danced to Earth, Wind, and Fire's September at a wedding reception or two, but should we be getting down now that we're in what historically has been the worst month of the year for stocks? Up next, lots to discuss, including some post-Labor Day turbulence with changing market leadership, much tougher sledding for one of the Magnificent Seven darlings, and maybe a somewhat under-the-radar rally in bonds. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. I'm Simon Hamilton, Managing Director here at the Wise Investor Group of Raymond James. Hope you had a great summer. I know summer is technically still in place, but hey, once we get the kids and grandkids back to school, it's over, right? So welcome to back to school season and welcome to a significant uptick in volatility over the course of the last month. So a lot to get to today. You don't have to go too far to find personal, local, or even company-specific stories that appear to contradict the headline economic data. I mean, the reality is, even during boom times, you'll find areas of the economy doing very poorly and anecdotes that seem to reflect conflicting narratives. I think that's certainly the case today. The unemployment rate is relatively low. Personal net worth is really high. Debt service to income levels are the lowest they've pretty much ever been. There's a lot of good news at the macro level, but that doesn't mean that everyone is sharing in that good news, right? So be careful relying too much on individual or specific circumstances that are sending a much different message than the overall data. Okay, I'll leave that topic, but I'm seeing more and more of this, so I just had to take a minute and mention it. Well, I mentioned Earth, Wind, and Fire's song September. September is already living up to its challenging reputation. If you go back, this is according to FactSet, go back to 1980, September's been the one month of the year, the only month of the year with a negative average return. If you go back further to 1928, markets produced a positive return in September only 43% of the time. So the fact that we're seeing some seasonal weakness is not unusual. I would also say the 2-month period before a November election has been consistently weaker, also since 1980. So some nervousness ahead of the election is, again, not unusual. And I'll also just say that, I said this when I was on the show a couple weeks ago, that bullish sentiment had gotten to an extreme level over the summer. We were all essentially fat and happy. And then we had that sharp sell-off in early August, right? Down almost 8% in 3 days. Market got overly negative. Now we're getting sort of overly positive again, which I think precipitated a little bit of selling here to start the month. So some of this is just sentiment extremes, in one direction or another. And I would say less interesting is the fact that the market's pulled back. Again, markets only pulled back a couple percent. That's not all that interesting. What is much more interesting, and this is what I want you to focus on, is the character of the market over the past few weeks, because it's changed. When the market sold off, 2 and change percent last Monday, the corners of the market that had already been giving up leadership led the way down. Technology, semiconductors, AI-related stocks. It's interesting how tech and the NASDAQ in general were both down more in that sharp pullback in early August than the overall market. And in the rebound since, have been unable to make new highs. I'll give you a specific example. In that sharp sell-off on Monday, the NASDAQ was off 3.3% versus about 1.3% for the equal weighted S&P 500. That's the S&P stripping out market capitalization and just putting all the stocks on an even playing field. This is according to Strategas. So we're seeing potentially some regime change here. Leadership is not found in the Magnificent Seven nor tech in general at this point. It's been utilities, it's been real estate investment trust REITs, it's been financials, some of the interest rate sensitive stocks, stock market sectors that are reacting to lower rates. We're starting to see some emerging leadership from healthcare for the first time in a long time, some of the more defensive areas of the market. So I'm not saying you should be selling tech. I'm not saying you should be dumping out of it, but to think that the next 3 to 6 months is going to look exactly like the last 3 to 6 months, where you could just buy an AI related stock or a semiconductor stock and close your eyes and go to the beach? I don't know that's going to be the case. Okay. So, and I would say that there's some sort of historical and fundamental underpinning for this. If you look at, again, this is according to Strategas, if you look at sector relative performance following Fed rate cuts, and of course, the first rate cut in this cycle is expected to be later this month. Okay, or at least that's what the consensus predicts. It's been pretty consistent. It's been the more defensive sectors, utilities, consumer staples, and healthcare that have tended to do the best. Again, every cycle is different. Okay, so this is not a prediction. This is just what we've seen in the past. And it's been technology that has traditionally struggled. From a fundamental perspective, if you go out and look at 2025 earnings estimates, the gap between what's expected from the Magnificent Seven and the rest of the market is the narrowest it's been in almost 5 years. Whereas in the last sort of 24 months, it's been the opposite. Magnificent Seven earnings estimates have been much higher than the rest of the market, which in part has led to much higher performance from the Magnificent Seven relative to the rest of the market. So maybe this, I use the term regime change, is somewhat justified by actual earnings expectations. So consider that in your thinking. And as I've mentioned earlier, a lot of this, inevitable is too strong of a word because, that implies that I have some sense of timing, which I don't. But one thing that I've highlighted in the past is the fact that virtually all money on Wall Street was going towards tech, Magnificent Seven / AI related names. Again, according to Strategas, if you go back to when the Fed paused their rate hikes, which was July 26th of 2023, a little over a year ago, and if you look at all the cumulative flows into exchange-traded funds, ETFs, technology, Strategas says, took in ballpark about $30 billion net new assets over that time frame. The rest of the sectors in the S&P combined, virtually no net inflows. So whenever you have virtually all money going in one direction, often you get something different going forward because there's just nowhere for that leading sector to go. So there are a lot of reasons why, like I said, you may be seeing some of this regime change. I don't want to oversell it. Who knows? I mean, things could look different 3 months from now. But for right now, some of those other areas of the market are doing better. So for those of you, hopefully those of you listening to this podcast who have kept their balance, not, sold all their healthcare and utilities and REITs and dumped it all into AI. And hopefully you haven't chased that rally. Hopefully you've kept some balance where you continue to own some of those names, but you're exposed to some of the laggard sectors as well. I think that's going to pay off. I really do. I would also just say that in general, a broader market tends to be a healthier market. Ned Davis research, there was a day, I think it was August 19th, I believe it was the day, Ned Davis research noted that on that day, 90% of the stocks in the S&P were above their 10-day moving averages, which is a measure of very positive short-term momentum. And I don't want to get overly technical here, but the takeaway from that is significant. When you've seen that type of trigger, according to Ned Davis, markets are higher 3 months later, 2/3 of the time, higher 6 months later, 76% of the time, higher 12 months later, 95% of the time. That's going back to 1982, 40 plus years. So that is a pretty good hit rate historically. And like I said, I think backs up the fact that a broader market could portend a healthier market overall. The only other thing I would just say, and I don't want to talk too much about valuations today, but there's been a lot of talk, obviously, about how the overall multiple on the S&P 500 is stretched by historical measures, well north of 20 times earnings. You back out the top 10 holdings, the largest 10 holdings in the S&P, drops closer to 17 times earnings. So I don't think the overall market is anywhere near as expensive as the headline index would have you believe. But even at the headline index level, just remember that valuations cheap or expensive, are a very poor timing indicator. Markets can stay expensive or inexpensive for long periods of time. I read a piece from Ritzold Asset Management where he noted, this is Ben Carlson, he wrote an article back in early March of 2017. What's that? Seven and a half years ago, where he noted that the CAPE ratio, C-A-P-E, the CAPE ratio, which is cyclically adjusted price to earnings, that's a measure that a lot of people look at because it smooths out earnings estimates in peaks and troughs, economic peaks and troughs. So a lot of people take a look at that. And he noted that, again, this is 7.5 years ago, right, that the CAPE ratio was over 30 at that time. The only two times it had crossed the 30 threshold was 1929, of course, on the precipice of the Great Depression, and 2000, on the precipice of the dot-com bubble implosion. Okay? Well, guess what? The S&P is up roughly 170% since that time. So here we have a historically expensive market by that measure. Market has rallied 170% in the ensuing 7.5 years. So take any sort of analysis of valuation as a reason to be out of the market with not just a grain of salt, with a significant pinch of salt. Okay. I want to change gears a little bit here. A couple things. I've been thinking and looking a lot at the fixed income markets recently. And if you're a client, you know we sent out an actual email about the bond market recently. Very much a topic of conversation internally here at the Wise Investor Group. It's less a topic of conversation, I think, in the headline media, right? We're still hearing a lot about the stock market. We're not hearing a lot about the bond market. And there are a couple things that really have stood out to me just over the course of the last week. One is that bond market's been doing a lot better than stock market recently. And I say recently, I mean, if you go back to the beginning of this quarter, first day of July, right? The Bloomberg U.S. Aggregate Bond Index, which is the bond index that we use in our performance reporting, as of Friday morning, was up 4.77% for the quarter. Okay. S&P 500, dividends included, up 1.33% for the quarter. So bonds at the headline index level up 3 times as much as stocks so far this quarter. Now, you may say, hey, Simon, I don't care about short-term performance. And you're right about that. I don't care about short-term performance either. But finally, for the first time in some time, bonds are delivering not just some hedging qualities against some of the volatility in stocks, but actual outright performance. And get to more of that in a second. The other thing that I saw was that money market fund assets have risen to another fresh record. According to Bank of America Global Research, roughly $24.89 billion with a B flowed into U.S. money market funds just in the week ending August 21st, which brings, again, according to them, the total stock of money market funds to an all-time high of almost $6.25 trillion. So even though the Fed has kind of signaled that they're about to start cutting rates, more and more money is coming into a vehicle that is going to be the most sensitive to rates. Because, money market rates are, for the most part, give or take a few basis points here and there, for the most part are going to move in lockstep with what the Fed's doing. Keep in mind current market expectations for the Fed funds rate. Now, again, take this with more than a grain of salt because the Fed fund futures have been grossly inaccurate over the course of the last year. Expectations for Fed rate cuts have been all over the place. But as it stands today, just so you know, right now the Fed funds futures are, around 5.3 in that range. Current expectations are for 2 years from now, August of 26th or September of 26th, that it will be all the way down to 3%. So 5 and change down to 3. With a high for this cycle of 9 cuts expected, 9 quarter-point cuts. Now, you might say, hey, Simon, 3% still not bad on my cash. And you might be right about that. Okay. But, relative to inflation, let's say inflation's still 3% or so around then. I don't know if it will be or won't. It's currently 2.9. But let's say inflation hovers around 3. Well, then you're not getting any pickup over inflation, right? And therefore you're not increasing your purchasing power. So that is something to keep in mind. So here's what I would suggest. I'm not going to lecture you about your cash position, but I think, in my opinion, there are only 4 reasons to hold cash in your investment portfolio. And they could be good reasons, but I think there are 4 reasons. One is you think that cash is going to outperform stocks and bonds. So from an investment perspective, you actually think that cash is going to do better than stocks and bonds. Well, that was certainly true in the recent past. In 2022, of course, stocks got killed and bonds got killed. Cash was king. Cash outperformed both. That has certainly not been true over the past 12 months. If you look at the S&P 500, if you look at that Bloomberg index that I referenced, cash has underperformed stocks and bonds at the index level. So there are certainly periods where cash has done better than other asset classes. The last 12 months have not been one of those periods. Second reason to hold cash is you want a certain amount of cash to either A, handle monthly withdrawal needs. We have a lot of clients who are retired, living off their portfolios, or you just want to have a certain number of months of cash on the books just as a safety net, should you lose your job or have a health issue, what have you. And, a lot of financial planners might suggest 6 months or 12 months or 18 months worth of cash. Those are legitimate reasons to keep some liquidity on the books. Third reason, of course, is for a planned expenditure. You're about to pay a tuition bill. You're about to do a remodel. You're buying a house. You're buying an expensive car. You want to have cash earmarked for that. And the fourth reason is a little more nebulous. You want to have a certain amount of cash so you can sleep at night. And I appreciate that. There are a lot of people that say, hey, I can't sleep if I don't have $100,000 in the bank. Okay, that's legitimate. You have to be able to sleep at night. So those are the 4 reasons to hold cash. I can't think of another reason. But my guess is, in speaking with clients and observing clients, that many people have in excess of the amounts required by those 4 things. Okay? In other words, you have cash kind of through inertia. So I'm not telling you to dump all your cash. I would just say, take a look in the mirror, maybe ask yourself, do I have more cash than what I need, based on maybe one of those reasons. All right, so let me talk a bit about the bond market right now. I think it is probably true. Well, it's not probably. It is true. The bond market's not going to wait around for the Fed to cut rates, right? So the bond market's already voting in real time. If you look at the 2-year Treasury yield, which traditionally or historically has been a pretty good referendum on where the market thinks the Fed's going to be, it's down in the 4.2 range, right? So 2-year Treasury is already suggesting significant, Fed cuts here over the next 12 months. Longer-term bond yields have come down as well. So the bond market's already way out in front of the Fed. So I do think it is fair to say that some of the projected lower rates, as well as better returns from bonds, price appreciation as rates come down, is already in the market, has already happened, for just to put it simpler. Okay, so we have to kind of keep that in mind. And the second part of that, though, is that, and I've mentioned this numerous times on this podcast, there's a very high correlation historically between starting yields and future returns. So even if we don't get a lot of additional drop in rate going forward, just the fact that you can start in the 3s, 4s, and 5s versus the 0s and 1s of a few years ago probably means that the overall return profile of your fixed income portfolio will reset closer to those 3, 4, and 5 some percentages. No guarantees. Past doesn't look like the future, but that has been the historical track record. Okay? So, but I did want to throw out those disclaimers. Essentially, the fact that we're starting from much higher yields than we've seen in the past 15 years gives you a higher margin of safety than you had a couple years ago. I think that's the better way to put it. I just wanted to mention briefly the relationship between stocks and bonds. I think a lot of people are still kind of stunned by 2022 because stocks went down over 20%. Most bond indices went down 16, 17%. So bonds offered no respite from stock risk. None at all. In fact, added to stock risk in many cases. Bonds actually did worse than the Dow, by the way. But historically, that is a rarity. It happens from time to time, but it is a relative rarity. According to Ritzel Asset Management, they went back to 1929 and looked at all the years when stocks lost money. And there were only a handful where bonds lost in the same year. I just mentioned 2022. The one prior to that was 2018, where S&P was down 4%. Bonds were basically flat. Before then, you had to go all the way back to 1969 to find a year where bonds lost money in the same year that stocks lost money. And by the way, when I say bonds, they were looking at 10-year Treasury return. That's what they were using as a bond proxy. Results can vary if you look at corporates or municipals or other types of asset classes. So I thought that was very interesting. Most of the time when stocks go down, bonds do in fact go up. High-quality bonds are a pretty good hedge against bad years in the stock market. But what I think what was even more interesting is Ritzel actually looked at the other side of this. How do bonds perform when stocks go up? Because a lot of people think that stocks and bonds are negatively correlated and that if stocks are having a great year, bonds can actually hurt you. Well, the historical record suggests that that is not actually true. So if you look at every positive year, just looked at every negative year, if you look at every positive year for the S&P 500, along with the corresponding return for 10-year treasuries going back to 1928, very interesting. Bonds, for the most part, had done just fine during up years for stocks. In fact, get this, average returns for 10-year treasuries have actually been higher during up years than down years. So again, if you look at I'll put it this way. The average performance in every up year since 1928 for stocks was 21%. Not every year, but every up year was 21%. Bonds averaged 5% a year in those years. If you look at every down year for stocks, the average decline was 13%. Average treasury performance during that period was 4%. So you actually did better with bonds in up years for stocks. So what's the takeaway? When the S&P was positive, bonds had a negative return 20% of the time. When the S&P 500 was negative, bonds had a negative return 19% of the time. This is, again, going back to 1928. The average returns were similar, and the win and loss rates were similar. So what does this tell you? Bottom line, bonds are a pretty good diversifier. And that's probably the way I would put it. Doesn't mean bonds are going to work for you 100% of the time. They won't. But a pretty darn good diversifier. And nothing over the course of the last 5 years has really changed that, in my opinion. Just a couple other side notes on bonds. A lot of people, of course, are talking about the fact that tax rates could go higher, and this could happen in a Trump or Harris administration. Remember, the current tax code is scheduled to sunset at the end of next year. So somebody has to act to extend these tax cuts. If you have a divided government, who knows if anything will happen. But the bottom line is, in my opinion, tax rates are likely, at least individual tax rates, are likely to be higher than lower over the next decade. And I think most observers would agree with that. And the other risk, of course, is that we go into an economic slowdown. That's one of the reasons that, interest rates could be coming down, that, crude oil prices could be coming down as there's concern about possible recession. I still don't think this should be our base case, but there's that risk. So if you're in the camp, or at least one of those camps, you don't have to be in both camps, but in the camp of either higher tax rates and or a possible recession, you really ought to think about whether municipal bonds, tax-free bonds, make sense for you. And for many people, they don't. So you really need to examine this on an individual basis, look at your own tax situation, your own, credit risk tolerance, okay? But for the right investor, municipal bonds could make some sense. I've mentioned before that the yield curves are steeper for municipal bonds than anywhere else. And what I mean by that is with treasuries, U.S. treasuries, longer-term rates are still below shorter-term rates. With corporates, the yield curve is flattish. You get a slight pickup in yield the further you go out, but not a huge pickup in yield. With municipal bonds, Their yields have come down recently, just like everything else in the last couple months. But longer term munis, 10, 15, 20 years and further out, are still, not only is it a steep yield curve, but quite attractive based on where they've been over the last 15 years. Just a couple things about municipal bonds. The credit quality of municipal bonds tends to be very high. There was a recent piece from Schwab. I want to give them a shout out because I thought it was very good. On average, according to them, only 9 out of 10,000 investment grade munis defaulted over a 10-year period, rolling 10-year period. That's going back 50 years. 9 out of 10,000. And recently, and they were speaking specifically to general obligation bonds, bonds backed by tax revenues, but they were looking at state and local municipalities and finding that the kind of quote unquote rainy day funds, the reserves of state and local municipalities are at their highest levels ever seen in 38 out of 50 states. And they also looked at municipal bonds during prior recessions. The difference between municipal bonds and corporate bonds is, corporations run into trouble. I mean, they can default literally overnight, and we've seen that, right? We've seen that with banks and other types of companies. Municipalities, the way that they work, they tend to keep reserves, as I just mentioned, and they tend to lag economic activity. So, for example, if you look at local governments, a lot of their finances are typically property revenues. Well, taxes are usually based on the assessed value of a property, which lags the market value. So a decline in housing and property values would not show up in lower tax revenues for a couple years afterwards. So, you look during the 2007, 2008, Great Recession, financial crisis, revenues for those municipalities didn't start declining until 2010. Credit ratings have been stable in the past recessions, much more stable than corporate bonds. And then as far as performance goes, again, this is according to Schwab, performance is generally positive following the onset of a recession. In 4 of the past 5 recessions, municipal bonds have posted positive total returns over the 12 months following the start of a recession. Only in the Great Financial Crisis did munis post a negative return in the 12 months after the start of a recession. And that was, remember, the worst financial crisis in 75 years. So I'm not, making a pitch for munis. Only, that really has to be decided on an individual client basis based on your situation. I would just say that, I think a lot of people in recent years have been loath to A, buy munis, B, go out, far in duration, in maturity with munis. Both of those may need to be reconsidered a bit. So I'll leave it there. Up next, stick with me. I want to take a quick break. I want to focus on a couple of the Magnificent 7 stocks. One that everybody thinks is the best thing since sliced bread, but you may want to be cautious. And one that people are becoming increasingly negative on, but you may want to actually consider being positive. Back in a minute.
Decelerating inflation, higher interest rates, volatile stock markets, new tax rules. Don't you think your financial plan could use a refresh? Tune in every week to hear Simon Hamilton and Chase Hinderstein discuss the latest financial trends and what investors need to know. To learn more about some of the most important planning topics, considering how to become a better informed wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Group podcast. I mentioned that I want to tackle a couple of Magnificent Seven stocks. Before I get into anything, just remember when I talk about individual companies, these are often names that we own for clients in our portfolios. And both of the ones I'm going to mention this morning, I also own personally, although in very small doses in my portfolio. That represents a conflict of interest, so you need to think about that. If you are a client and it's something that we own for you, I think you can feel pretty comfortable that we've done our due diligence and feel it's appropriate for your particular situation. If you're not a client, can't manage your money through the computer here, you really have to do your own due diligence. So I want to mention NVIDIA. It's not a stock that we own across our client base, although we do have some clients that own it individually. I have a smidge myself. Of course, I wish I had more than a smidge based on their performance over the last couple of years, but I do own a little bit. I have to mention NVIDIA. I mean, no other stock offers NVIDIA's combination of name recognition, but also enormous volatility, unrivaled liquidity, and really what has become sort of meme value, right? I mean, it's like Tesla was, or maybe Tesla still is, but it has that kind of cult quality to it, right? And what's interesting about NVIDIA, and I'll mention this today because the stock is down 25% since they peaked in June. So that bears some discussion, especially since the news flow from NVIDIA has been almost overwhelmingly positive. So I thought it'd be worth a little bit of sort of exploration, if you will. I will say that the outlook for NVIDIA, I'm not sure I'd use the word guess, but it is uncertain despite anything that you read. I mean, just AI in general. I mean, it's just like the internet was or the cell phone was. Whenever you have an emerging technology, you don't know how it's going to play out. And you don't know if the people and the companies who are the players initially will be the players, 5-10 years into it. I mean, when was the last time you fired up your Commodore computer or your Nokia cell phone? Okay. Who knows who the leaders will be in AI a few years from now? So, and just in general, we don't know if the profitability will collapse as the AI bubble bursts, whether it'll be sustained as AI reaches into ever greater parts of our lives, or will continue to grow at these types of eye-popping rates for years to come. We don't know. And because of that, it makes valuations of companies like NVIDIA very, very challenging. I mean, the present value of their future profits requires plugging in estimates that are kind of guesses at this point. Maybe guess isn't too strong of a word. And I'll get to that more in a minute. But one of the things that kind of drew my attention in the last couple of weeks is I read a piece from Axios, and what they were mentioning is how there are at least 10 ETFs, exchange-traded funds, maybe more, that do nothing but trade NVIDIA options on an intraday basis. What's more, there's been a huge rise in what they call night traders. These are people who, not you and me, by the way, that essentially trade NVIDIA after hours. So in the day a couple weeks ago, I guess after their earnings it was, when NVIDIA dropped, I forget what it was, 11 or 12% in one day. There were 44 million shares of NVIDIA traded the night after their earnings, worth more than $5 billion in a single hour. Single hour. To put that in context, ExxonMobil sees about 13 million shares or $1.5 billion during a typical daytime session. So when you're getting that type of short-term speculation up or down in a stock, it's almost impossible to put a valuation on the company on a day-to-day basis. You're just buying it on the hopes, or you should be buying it on the hopes that it's all going to work out a few years from now. But I really would caution you against buying it for a short-term performance expectation. There's so much trading in this stock that has nothing to do with the way that you're trading the stock to have confidence in what the stock may or may not do over short periods of time. Just to back up and give you a little bit of background, NVIDIA Of course, following the release of ChatGPT in November of 22, the demand for GPUs, which is all the additional computing needs, which stands for graphical processing units, went through the roof. And that's what NVIDIA produces, right? And it produces them up until now better than anyone else. And what is crazy is how much of the capital expenditure budget of the other Mag 7 is flowing directly towards NVIDIA. So according to Nick Majuli, he's a financial blogger I've referenced before. He did a kind of a deep dive on NVIDIA. According to him, Microsoft now spends 40% of their total CapEx on NVIDIA, up from 10% a year ago. Meta, formerly known as Facebook, also 40%. Tesla, 30%. Google, now known as Alphabet, 15%. Amazon, 10%. So they essentially, depending on who you talk to, have somewhere between 80 and 95% of market share in AI computing. So no wonder their numbers have been going through the roof. If you look at their most recent quarter, according to Majuli, actually this is FactSet numbers, revenue surged to $30 billion. That was up 122% over the prior 12 months. Net income, $16.6 billion. That was up 168% over the prior 12 months. No company of their size or close to their size has ever put up these types of growth numbers. But guess what? The stock is down 25% from the June peak and something like 15, I don't know the exact figure, somewhere between 15 and 20% just since that stellar earnings report. So what's going on? Well, the problem is valuation. As impressive as their growth has been, their valuation is sky high. And I'm not making a judgment call when I say sky high. This is not a research piece. This is just factually, objectively, soberly looking at their numbers versus other types of valuations we've seen in the past. I mean, if you look at their price to sales ratio, and I say price to sales because you can't fake price to sales. You can manipulate earnings. You can do weird things with that, and the way you do your accounting, but it's hard to fake sales. Compare them to Microsoft at the peak of the dot-com bubble. Microsoft was trading roughly 30 times sales. NVIDIA now is close to 40 times sales. 40. What happened when Microsoft hit 30 times sales? Well, the stock got cut in half during the dot-com bubble, didn't do anything. I know this because I own the stock personally at that time. They didn't do anything for 14 and a half years. Microsoft basically didn't move from January of 2000 to July of 2014. And I've just finished saying earlier in the podcast that valuation is not a good timing indicator, but it definitely should raise your antennae when you get to extremes. And this is an extreme valuation. This same guy, Nick Majuli, the last time he wrote about stock market froth was in November of 2021. And that's when the total stock market capitalization of all the companies over 20 times sales was over $4 trillion. He was early. It peaked at $6 trillion a couple months later in January of 22. And that was the peak of the market until we exceeded that, this year. But now we're back to over $4 trillion again. And 2/3 of that $4 trillion is in one stock, NVIDIA. Now, Majuli is the first one to say that, his timing's not right. He disclosed how he got kind of cautionary on Tesla in January of 21. It went up another 45% after he got cautionary, publicly cautionary. So his timing was lousy. But the stock's down as of this week, about 25% since that time, since he got cautionary. So let me be clear. I'm not making any sort of judgment call on NVIDIA. It's a fantastic company with a fantastic story and a fantastic growth rate. But the bar is so incredibly high for that company that you are taking on risk if you think that the stock is going to deliver, certainly short-term performance. But given how vague the numbers are, 2, 3, 4 years from now, you're also taking on some execution risk over a longer holding period. Even if their top line, the sales growth continues as it has, what we started to see in this most recent quarter was an ebbing of their profit margins. And I think that could come from a couple fronts, right? You could have more competition, more price competition, but also some of the big guys, the Microsofts, Facebooks, Googles of the world who are buying from them may not always be willing to pay the type of premium prices they're paying today. So all I'm saying is take a look. If you have NVIDIA, hey, God bless you. You've had a phenomenal performance because even though the stock's down 25%, since June, still up over 140% for the year. So if you've had it, God bless you. You've made a lot of money. Just make sure that you have some balance in your portfolio. I'm always wary of concentrated positions, and just be wary of, because of so much short-term trading, I don't want to say price manipulation, but trading the stock unrelated to fundamentals, you really want to be careful about having a short-term price objective for something like that. The other one I just wanted to mention is sort of the opposite, and I just have a couple minutes left here, but it's sort of the opposite, and that's Google, formerly known as Alphabet. I think you all know Google. I don't want to say people have soured on Google, but there has been, of course, a well-telegraphed reports that the antitrust folks here in the U.S. have a lot of problems with Google. And there's been the talk of a possible breakup of the company and what that would do. And there's been sort of a negative overhang on Google that may persist for some time. And we've seen it before. Remember, Microsoft came under significant antitrust scrutiny not too long ago. Google's coming under some of that same scrutiny. What's interesting about Google, and again, this is a company I own personally, okay, so that's a conflict of interest. You need to consider that. Pre-COVID, not that long ago, Google's search, their search engine and their related properties drove over 100% of the consolidated earnings for that company. YouTube was at best break even, maybe even losing money. Their cloud business was losing money. And Waymo, which is their automated car business, was losing a ton of money. So everything was coming from search. Well, in just the past few years, and here's the bottom line, in just the past few years, all three core segments will have flipped from break-even or losses to generating a ton of cash flow, particularly their cloud business. I mean, their cloud segment in 2019 was losing a lot. Their margins are still way below what Amazon and Microsoft get on their cloud search products. There's the expectation from FactSet and the analyst here at Raymond James that will sort of equalize, that Google will become much more profitable in cloud storage over the course of the next couple of years. YouTube, from the most recent quarter, has already flipped significantly. And the car business, the automated car business, is very interesting. I mean, for a number of years, Waymo was sort of considered a boondoggle for them, a white elephant, something they spent a lot of R&D money on that may never come to fruition. Well, the reality is it is coming to fruition. And there was a really good piece from a company called JPM, a research firm, and they were just talking about the fact that Waymo is already legitimately profitable, inclusive of capital expenditure depreciation. In fact, according to them, their margins are already above 60%, and that'll improve as utilization improves, at the same rate. That's not even in the analysts' estimates at this point. And if you look at their core sort of AI business, Bill Ackman, the hedge fund manager, he just added to his Google position. And in his recent newsletter, he was just saying that, Google, of course, is meaningfully ramping up their AI investments, as I mentioned just a minute ago with NVIDIA. They are innovating with their own type of chip, which in many ways will compete with NVIDIA at some point. And just as kind of a proof point, compute costs for Google's generative AI search responses are down 80% from just a year ago. So what he calls step function improvements uniquely position Google to scale its AI capabilities to a user base of over 2 billion customers. That's a quote from the most recent Ackman newsletter. So, Google, I think, is interesting. And I, unlike NVIDIA that trades at, over 40 times sales, Google is down to about 18 times 2025 FactSet estimates. That's not only a 20% discount to where they've traded over the past few years, but also a significant discount to the S&P 500. They're trading at a discount to the S&P 500, despite traditionally trading, according to FactSet, at a 1.25 multiple to S&P 500. So there are certainly risks to the story. The main risk is we just don't know what the competitive landscape is going to play out, right? We don't know who is going to capture. We know who has the market share today. We don't know who has the market share 3, 5, 10 years from now. And certainly AI does threaten some of what they're doing on the search side, and that's yet to be quantified. So there are certainly risks to the story. But I honestly believe that in a breakup or divestiture type scenario, that Google could be worth more dead than alive. In other words, the pieces, for the first time in several years, could be worth more than the whole. So I think it's interesting, and I think the risk-reward trade-off there is something, at the very least, you ought to take a look at. Again, I own these names myself. We own Google for clients. NVDA, we don't own across the book, but some of our clients do have it. Keep that in mind as you evaluate what I've just said. Hope that was helpful. I know we covered a lot of ground here. Stay tuned. I'll be back with you in a couple weeks, I believe. Next week, one of our financial planners will be on. So there's a lot of topics that you need to consider going into the end of the year from a planning perspective. So I think that'll be a good show. Stay healthy. And as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.